Since September 2018, Apple stock is up 280% after adding another 2% early Monday as I'm recording. That's compared to Apple's revenue growing just 44%. The multiples for Apple, price to sales multiple, the price to earnings multiple, has really driven the company's growth. And one of the things that I think investors really need to be worried about right now with Apple is not, is this a strong company? Is it going to continue turning out cash flow year after year? It's, can the company grow? Price to earnings multiple is now well over 30, and that is a multiple that would indicate investors are expecting a lot of growth. That means that the earnings yield is right around 3%. You can get 5% in treasuries today. So what exactly is going on with Apple? Well, I think part of the reason that the stock continues to go up is investors just don't have better ideas. You might as well just buy the big cap, big tech companies and just continue to ride this wave. The latest thing over the last couple of weeks has been artificial intelligence. Apple seems really well positioned in artificial intelligence, but is that going to actually increase their revenue? Are people going to be buying more iPhones? Maybe, maybe not. But also it's very possible that those iPhones that people are buying are going to be more expensive. Not just more expensive to sell, but more expensive to make. It's possible that margins decline because of the costs that go into adding the chips and the software capabilities, that cloud capabilities for Apple Intelligence. Those are going to be costly incremental costs for Apple that I don't think investors are really considering today. So I want to go over the actual trends from the business today, show why this is not really a growth company anymore, except for a couple of small areas. And those areas are not necessarily going to be long-term growers for Apple. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. So first of all, let's just go through Apple's overall revenue and then each of their most important revenue segments. You can see here from this chart, compound annual growth rate since 2018, the September 2018 fiscal year, compound annual growth rate is just 6.8%. But since September 2022, revenue has been on the decline. So overall, the trend is there was a little bit of growth during that pandemic timeframe, but now revenue is on the decline. So that's overall what Apple looks like. Let's look at the iPhone. This is iPhone revenue. You can see that the compound annual growth rate since 2018, 3.5%. So pretty weak growth rate overall. There was a little bit of a dip there during the pandemic. But as those stimulus checks came out in late 2020, early 2021, sales picked up, but then started to decline again in 2023 and early 2024. Mac and iPad revenue, you see similar trends. Sales pick up in 2021. Were actually really good for Mac in 2022 and then started to decline again. Since 2018, that growth rate is in the low single digits. And over the last couple of years, you're starting to see declines. So the business is deteriorating as the stock is going up. Where has there actually been growth for Apple? There's two regions. There's really two segments that have done really well. The first is wearables. And you can see that there was wearables momentum through 2022. And this would have been as there was more and more advances in AirPods specifically. So the main drivers of these wearables is going to be the Apple Watch and AirPods. Those are kind of the two big products. Apple Watch, I think, has kind of hit saturation in the market. They're not making huge improvements on a year-over-year basis. There's not a big infrastructure of apps being built for the Apple Watch. So it has a good niche product. It's a great business. A lot of companies would love to have a business of that size. But for Apple, relatively small and not really growing. AirPods were a huge growth driver in the late 2010s and early 2020s. But that has obviously slowed. You can see that revenue in the wearables, home and accessories business has been on the decline since, again, the September 2022 fiscal year. So this was a growth driver. It is no longer a growth driver. So what is growing? The only thing that is consistently growing for Apple is services revenue. There are two main drivers of services revenue. One is the 30% cut that Apple takes from app purchases and all those digital solutions that they're selling. Every time you subscribe to something, whether it's a streaming service or a game, if you're buying digital goods, Apple is taking a 30% cut from a vast majority of those transactions. Apple is also getting a very, very large check from Google in the range of about $20 billion. That is included in this services segment. And that's to be the default search engine on Safari. So why is all of this so important to think about when we look at where Apple is today. Well, if Apple is going to be in the artificial intelligence business and it's going to be including all of those AI services on device, what are you going to be doing less on your device? You're probably going to be searching less. You're going to be opening up that browser using Google search less, because that's what's directly built into the Safari browser. Even if you're asking Siri a question, if Siri doesn't know the answer, it's going to send you to the browser and Google search that is monetized then by Apple. Apple is not monetizing Apple Intelligence as far as we know today. There is the on-device compute, which Apple is going to be doing itself. There's the first layer of cloud compute, which Apple is going to be doing itself. And then the next layer is if there is an inference where Apple doesn't know the answer based on what is on your device or what is available in their kind of limited cloud service. It's going to push you to ChatGPT, potentially to something like Gemini in the future. But it does not appear today that those are a revenue share model. That is just going to be a service that Apple's going to be providing. So if you're doing more AI on Apple devices, it means you're going to be doing less searches. That means less services revenue. That means that the only growth segment that Apple has today is going to deteriorate if Apple is successful in artificial intelligence. This is the weird thing about where Apple's stock is today, is that I think investors are rightly saying that Apple is really well positioned strategically in artificial intelligence. I think that's absolutely true. The problem is they're not well positioned when it comes from a revenue perspective, because they don't have growth in iPhones today. They don't have growth in Macs or iPads or even things like watches and AirPods. Its only growth segment is services, and those services are really driven by the 30% tax that they have on all digital transactions and Google search. And all of those things could deteriorate further in the future, which really makes the valuation questionable. The other thing to think about is what's happened to Apple's most recent product launches. And this is where I think investors really need to think long-term about who is driving value in the current digital ecosystem. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. What's really driven Apple's success, particularly on that services side of the business, is that this is really a two-sided market. You have Apple making devices, hardware and software that's integrated. Customers are buying them from Apple at a very high margin. Developers are also building software that makes those devices even more valuable, and they're also paying Apple. So everybody's paying Apple in this ecosystem. As long as the devices are selling at a really high rate, that flywheel is going to continue. But let's look at the two major products that Apple's introduced really over the past decade. The Apple Watch. Apps just simply didn't work with the Apple Watch. The company's really pivoted to that being more of a fitness product. But that I don't think necessarily fits in the current Apple ecosystem and what they're trying to build, because they're really growing the business on the back of the iPhone in particular. The other thing is the Apple Vision Pro, so virtual reality. This was supposed to be the next big thing for Apple. Guess what? Developers don't want to build for the Vision Pro. Not only does it not have any sort of critical mass, but developers don't want to get stuck in a situation where they're building something for Apple and Apple's just going to take a 30% cut for what they're doing in perpetuity. This is the problem with all of the lawsuits that have happened with Apple, with Epic. There's been conflicts with Spotify. Apple just ultimately, if there's something valuable, they end up eating that part of the ecosystem. They make their own app and they integrate it into the ecosystem. So why would you build an app for Apple to be able to watch Netflix or YouTube on the Apple Vision Pro, which could be really great experiences, when Apple is just going to turn around and say, hey, you know what? We want a 30% cut of all the revenue that you're making. This is the position that Apple has gotten itself into, leaning so hard into the services revenue, leaning so hard into the money that it makes from Google, the money that it makes from developers from that 30% cut. And this is really why I question if Apple is worth the multiple that investors are paying today. So let's get to that. This is the price to earnings multiple in orange, 33.5. Just a massive price to earnings multiple. The price to sales multiple, 8.5. Those have both increased dramatically over the past decade. And in a lot of ways, Apple has earned that because they have such a dominant position in the market. But remember, you're paying a very high multiple for a company that is no longer growing. And that's where I really question whether Apple is a good value. I have been selling shares slowly over the past year, but I may do that a little bit more aggressively because I think the stock has just gotten so expensive that there's no real way that Apple's going to be able to live up to this. It's much more likely that Apple is going to not necessarily be disrupted, but some of these profits are going to get eaten away over the next decade or so as we have more devices, as people refresh their smartphones less frequently. Same thing with Macs and iPads. This is not a business that's fundamentally built to grow in 2024 the way that it was in 2014. So I think this is something investors need to think about with the current valuation of Apple. I think shares have just ridden too high on the back of this big tech artificial intelligence trade. But what do you think? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.